Hello everyone, welcome back to this exercise series for Chapter 8 from our Managerial Accounting course, ACCT 428. In this video, we're going to be looking at exercise 8-3A, similar to the previous exercise, similar to 2A, but the only difference here is that we're going to also calculate the variance, okay? So let's read the exercise together. It says, required, compute variances for the following items and indicate whether each variance is favorable, F. So any variance that is favorable, we're going to indicate with the letter F, or unfavorable, and for those, we're going to indicate them by the letter U. So let's read the first one. Sales price. The budget was for $400 per unit, and the actual $390 per unit. Now I'll give you a very simple rule to follow. Now if we look at the net income of a company, we can simplify it following a basic rule that net income equals total revenues minus total expenses. Right? We already know this. So for any variances that are given to you, you need to see whether the item itself is going to fall under revenues. So it's going to generate revenues for us. In this case, as you can see, revenue has a positive relationship to net income. So the higher the revenue is, the more net income we're going to have. So it's going to increase our margins. Whereas for any expenses or costs, they have a negative relationship to net income. So the higher the total expenses, the less net income we're going to end up with, right? So for any item, you need to first analyze and see, is it going to serve our revenue? Does it relate to our revenue, or does it relate to costs and expenses? If it relates to revenue, if the actual is higher than the budget, then that is a favorable variance because it's going to increase our margin, and as a result, it's going to increase our net income, right? And if the actual is less than the budget, then that is going to decrease our revenues. And as a result, decrease our margins and decrease our net income. So that would be unfavorable variance. For costs and expenses, on the other hand, it's the other way around, okay? So if the cost is in reality, or the actual cost or expense is higher than what was budgeted, then that would decrease our margins and decrease our net income. So it's going to have a negative effect on our net income, and as a result, we're going to denote it as an unfavorable variance. And if the actual cost is less than the budget, then that would do the opposite. That would reduce our costs than what we had planned, and as a result, increase our margins and increase our net income. So that would be a favorable change, okay? So let's look at them one by one. For the first one, sales price per unit serves our total revenue, right? The higher the price, the better for us. So the budget was for $400 per unit, and the actual is $390 per unit. So the actual is less than what was budgeted. So the company had to sell for a lower price than they had planned initially. So that obviously is unfavorable change. So we're gonna say U. Now, what's the magnitude of the variance? We're just going to subtract. So 400 minus 390, that's $10 variance. Okay. Next, sales revenue. Again, that pours into that total revenue bucket that we talked about earlier. Okay. The budget was 360,000 and the actual was 390,000. So the actual is greater than the budget. Because this is the revenue, of course, having higher revenue than the company had initially planned is a good thing, is a positive thing. So that would be a favorable variance. So say F. What's the magnitude? As you can see, the magnitude is a difference of 30,000. So 390,000 as compared to 360,000. That's an increase of $30,000. Now for the remaining items, all can be categorized as costs or expensive, whether it was a dollar amount or a usage variance. So let's see. First one, cost of goods sold. The budget was expecting $192,500 cost of goods sold, but the actual cost of goods sold was only $180,000. So the company incurred less dollar amount in cost of goods sold. Okay, so the actual is less than the budget, but this is a cost. So the lower the cost, the better. So that is a favorable variance. So we'll say F. What's the amount of the difference? As you can see, between 192,500 and 180, that's a difference of $12,500. $12,500. Next one, material purchases at 5,000 pounds. The budget was 137,500 and the actual was 140,000. Okay, this falls within the total expenses bucket we talked about earlier, and as you can see, the actual is higher than the budget, so that is unfavorable. So we'll say U right here. What's the difference between 140,000 and 137,500? That's a 2,500 variance. 2,500. Okay. Next one, materials usage. The budget was forecasting $90,000 and the actual was only $89,000. So that's less. The actual is less than the budget, so that is favorable. So I'll come to the last column here and write F, and the difference is $1,000. Sorry, we put it a little higher up. Production volume, 950 units, the budget, and the actual was only 900 units. So they produced less than they had planned, and of course that would be considered a unfavorable variance. The level of activity, the more the company produces, the better. So in this scenario, they were forecasting to produce 950 units. They ended up only producing 900. So there's a difference of 50 units. Okay, be careful with the units part. This is not in dollars. And this variance in particular is unfavorable. Next one, wages at 4,000 hours. The budget was $30,000 and the actual cost or expense for wages was $29,350. So the actual cost here is lower than the budgeted cost, so that would be a favorable variance. So we'll write F, and the difference is 30,000 minus 29,350. I know it's simple numbers. I can calculate them on my head, but sometimes or most of the time I would recommend to just be careful and make sure you use your calculator, since you are allowed to use your calculator in the exam, just to be on the safe side and not rush into conclusions and make errors simple errors like these and lose marks. Okay. Next one, labor usage at $12 per hour. The budget was 48,000. The actual was 48,500. As you can see, this is another cost, and it's higher than the budget. So the difference of $500, and that is unfavorable difference. Next one, research and development expense. The budget was $11,000. The actual was 12,500. The actual is higher than the budget, so that is also unfavorable. And the difference is $1,500. Okay. Finally, selling and administrative expenses. The budget was for 24,500. The actual cost was, or the actual expense was $20,000 only. So the actual is less than the budget. That is favorable variance, and the amount of variance is $4,500. Okay. Another simple question, similar, as I said, to the previous exercise. The only difference is in this one, we are having to also calculate the magnitude of the variance and not just decide if it's a favorable or unfavorable variance. I hope you found this video useful. If you have any questions, please feel free to drop them down in the comments. This is how you solve a similar exercise to exercise 8-3A. Thank you for watching, and until I see you in the next video in this exercise series, take care.